Yeah, so there's so much to talk about in the markets right now, and you've written some recent pieces that I want to dig into. But first, I just want to get your general reactions to the equity market specifically. Year to date, we have the Nasdaq off to one of its hottest starts ever, and it's been really concentrated to almost seven stocks. I think seven stocks make up 85% of the S&P 500 gains so far this year. And so, what do you think of this equity rally in general? What do you think is driving it, and how do you feel about how narrow it's been?
So far, I think the biggest correlate has been liquidity. There's different ways to measure liquidity, but back in say the first half of 2022, which was terrible for most assets in general, you had both the Fed and the Treasury pulling liquidity out of the financial system, and then starting late last year, had the Treasury put in liquidity back in, basically reducing their cash account, which is like this basically this void of cash that's not being used, and when they're diminishing it, they're basically putting it back into the market, and they had to go lower than they expected because of the debt ceiling. So they had to drive it all the way down to roughly zero at the start of June, and so for that like say roughly 9 month period, 8 month period, you had the Treasury offsetting the Fed, and so you started to get flat and even slightly higher liquidity conditions. When you also include things like Fed liquidity injections to the banking issues in March, and so you started if you map out the stock market relative liquidity, it follows it pretty closely. In recent months, I think things have gotten a little bit euphoric. The stock market's kind of gotten ahead of what you'd expect based on liquidity alone. Obviously, it's not the only variable. There's other things to consider, but the enthusiasm around AI and tech. And things that are generally perceived to be recession resistant, and that benefit from the Fed kind of getting to the top of their rate hiking cycle, have, in my opinion, been somewhat overbought. There's a lot of indicators that retail type of investors are kind of aping into it to some extent. Um, and it's hard to justify some of these equity valuations when you compare it to, say, a 5% discount rate. Many of them are trading at valuations that you'd normally see before, back when the alternative was like 0, 1, 2% interest rates. And so I am concerned around the narrow scope of the rally and this final multi-month move we've seen in some of these assets. But I think other parts of the market are trading reasonably. They're doing what we'd expect in the face of kind of neutral liquidity conditions. Um, and then I think, as we'll talk about later, there's really big forces that are stimulating the economy as well. Very large fiscal deficits that are kind of, again, it's sort of a case where the Treasury in some cases is offsetting some of what the Fed's doing. And some of that I think is manifesting in the stock market.
Yeah, you brought up liquidity being kind of one of the key drivers of this rally of not just equities, but Bitcoin. Bitcoin's described as a liquidity sponge a lot of times. It's a liquidity driven asset. And you talked about how there's these dynamics between the Treasury General account getting drained down, kind of offsetting some of this quantitative tightening. And now there's a really different dynamic going on with them refilling the Treasury General account. So we had this whole debt ceiling drama and it got resolved, but then there was a lot of concerns over how that would actually affect liquidity. And you kind of pointed to some of these dynamics. What do you think about it now, and how has it played out since the debt ceiling was resolved and they started refilling the Treasury General account? How has it impacted liquidity, or how are you seeing things?
So far, it's been relatively neutral because the Treasury essentially had to blink. So when we saw this liquidity suck coming, so basically the Treasury was transitioning to a point where instead of drawing down, its cash account is going to start refilling it, as you pointed out, and that all else equal would be net negative for liquidity, assuming the Fed keeps doing what they're doing. Um, the only ways around that would be that the Fed could pivot and assist with some of that Treasury issuance by monetizing it, and the other option is that there's the over $2 trillion in reverse repos, which is basically another dead pool of capital. And mostly what that represents is spillover for T-bills. So there's more demand for T-bills, specifically like the short duration part of the debt curve, than there is for them. And so one of the risks is that basically you'd have so much demand for T-bills that you'd push the yield below the Fed's interest rate target, below the lower bound of it. And so one of the things they do to try to maintain their interest rate target is they have this reverse repo facility that is like a spillover. So if there's extra demand, they can instead go in there. And the market is made over, I think the peak was like over 2.2 trillion, maybe higher usage of that facility. And long duration treasuries, if they issue a lot of long duration treasuries, it won't impact that facility. That'll come out of like bank reserves. Whereas if they specifically issue a lot of T bills, that can suck some liquidity back out of that reverse repo facility and finance it that way, which is basically neutral for liquidity. They're not sucking out of the banking system; they're sucking out of this like void of reverse repos, which is mostly money markets. And from the money market perspective, you don't really care if you're holding T bills or reverse repos; they're kind of the same thing from a end user perspective. Now, what makes it interesting is that the right now, because the yield curve's inverted, the T-bills are the most expensive part of the curve to finance on, right? So when the Treasury decides what types of instruments it's going to issue to finance its deficits, it has a variety of different things to consider. How's it going to get the best deal for the government? Like, what's the lowest yield with which it can finance this, as well as taking into account things like liquidity and other problems like that. And so what's interesting is that they made the decision to finance it almost entirely with T-bills.
Hmm.
There's a very high ratio of T-bills that they're using. So they're basically sacrificing cost. So they're financing on the most expensive part of the curve in order to be beneficial or at least less harmful for liquidity than if they tried to say issue a bunch of 10 years, like a flood of 10-year
Yeah.
treasury notes. And so far, they've been effective at pulling a good chunk out of reverse repos. I think we have to keep watching it because so what makes the data complicated is that mid June had quarterly tax payments that disrupts the data for a period of time. But so far, the signs are pointing towards when you look at their issuance schedule and towards what's been happening, they've been drawing most of their issuance out of reverse repos. And as long as they're willing and able to do that, so as long as they want to keep issuing on the short, expensive part of the curve, basically just kind of reducing the government's average debt duration, then they have basically almost $2 trillion or $1.9 trillion to kind of keep pulling from without sucking out of banks. So I think that's kind of the main thing that they're going to probably try to do their best to keep drawing down, because that delays when the Fed, for example, has to do more quantitative easing, and that kind of pushes away at least some of these more serious liquidity issues.